Welcome to the ONS Energy Talks, a podcast where you meet experts on energy, technology, and sustainability.
To the ONS Energy Talks. Today we will discuss the uncertain times that we're in. We have seen the corona situation, we've seen turmoils in the energy markets, and how will the different corporates react to this uncertainty. My name is Ingvild Mæland. I'm the program director in the ONS Foundation. But today we have with us two global capacities to help us to shed light on the challenges and to see if we can find some answers. First, Valentina Kretzschmar is with us. She's the Vice President for Corporate Research with Mackenzie. She's been with Mackenzie for more than 20 years, and her expertise in looking at the corporate strategies, especially connected to the energy transition. And secondly, we have with us Simon Flowers, who's actually the chairman and the chief analyst in Mackenzie and the author of The Edge. I'm really looking forward to the conversation that the two of you will have on these topics. And I wish you good luck, and I leave the floor to you, Valentina.
Thank you, Ingvild, and thank you for inviting us. It's a great pleasure to be here to take part in this webinar series for ONS. But actually, I would like to give floor to Simon. Simon, could you give us some sort of idea as to what is really happening out there against the backdrop of coronavirus slump in demand and the current Saudi Arabia-Russia price war? How is the industry responding to this turmoil that it has been thrown into?
Yeah, thank you, Vanya, and welcome everybody who's dialed in. You can see that we're calling in from our homes, comfortable here, but we daren't look out the window because there is the perfect storm unfolding out there. Let me talk a little bit about what we think is going on in the oil market. So at the beginning of the year, oil demand had reached an all-time peak of 100 million barrels per day, and since then, we've had the coronavirus, which has had a significant effect on global economic growth, starting in China, rippling out to Europe and the US and everywhere else too. And it's having a serious effect on demand. So from 100 million barrels per day, we're expecting demand to fall to 90 million barrels per day in quarter two. Quarter two, we think, is the worst point, but the world has never seen such a calamitous drop in oil demand as that. And to top it all, we're coming from a period where OPEC and its partners in OPEC Plus has managed supply to keep the price around $50 or $60 a barrel, but the cartel and Russia and its other cohorts has fallen apart, and we've gone into this price war, which Vanya mentioned. So supply is actually going up, and in Q2 we're going to see Saudi Arabia add another 2 million barrels plus per day. One or two other countries like Kuwait and Abu Dhabi can also increase production. So we have this very, very difficult oil market from April onwards. We think for about 3, maybe maximum 6 months, but Q2 is going to be the worst. So the price has already fallen from an average of $63 in quarter four to the present price of $25 a barrel, and we're nervous about what unfolds over the next few weeks. It's possible it'll dip well below $25 a barrel, perhaps not for terribly long, but this is when the maximum pressure is coming. So this is a very, very good time to talk, just ahead of what we think is the maximum squeeze. I'll also say a few words about gas, because gas got there early. So gas price has been falling over the last year. In fact, in the middle of last year, it was as high as $8 per MMBTU in Europe. Well, it's now about $3 per barrel, and much of that happened well before coronavirus because there's just too much supply. I think the final point I mentioned is that the slowing economic growth is affecting every sector in the world, of course, but oil and gas is having to cope with the double whammy. We have a recession, but we've also got this very weak price environment having to operate in. So it's a very difficult time in 2020 for oil and gas companies.
It certainly is, Simon. It's absolutely unprecedented, and it's not been that long ago that the sector had to deal with similar situation back in 2014, 2015, when the oil price collapse happened, when it actually did have some fat to cut, when the average cash flow break-even was around $100 per barrel across the sector. But they were able to bring costs down through strict capital discipline and capital allocation. What can they do this time around? How is the industry responding to this situation now?
You're absolutely right to say it's the second time in 6 years that we've had to face this, and the industry has got its costs down so it needs an average price this year of about $53 Brent. So it puts it in very stark terms, sitting on a spot price today of $25. But the industry has learned a great deal and is ready to act very quickly, doing some of the things it did last time around. And in fact, it's been very decisive. Most companies have done stuff already, and they've been very quick about it. And the sorts of things we've seen, let me go through the checklist. I think if I were the CFO or CEO of an oil company, number one, I'd make sure I had access to funds if I possibly could. So those companies that have a good credit rating have tapped into debt markets to make sure that if there's a cash shortfall, they can borrow a bit more money. But that's open to very few. The second thing is you start to cut costs, and this is a global phenomenon, and the quickest to react have been those companies in the US independents that are drilling tight oil or shale gas. They've cut by between 20 and 40%, most of them, but a handful have already cut by 50%. So we're talking about really substantial cost cuts. The majors are also leading the way among the conventional players, and we've seen substantial cuts there of around 20% in operating cost cuts from Shell, from Chevron, and from Total as well, and the others will follow. I think Equinor came out yesterday and made a statement on that, so everybody's getting on the same page. The third thing they can do, of course, is operating costs, and we've just begun to see what's happening there. It takes a little bit of time to get your operating costs down, so it's not as instantaneous as switching off investment in the lower 48, but operating costs will be a key target through the course of this. And so what companies are doing, they're focusing on what levers can we pull to get costs down. And they made a very good start, but there's still a lot of work to do.
Sure. Given that, we are obviously here in the UK, and the North Sea producers have been struggling already, even before the coronavirus, to actually hit these lower break-evens that were required. How is this going to affect the North Sea and across Europe, North Sea producers?
Well, the North Sea, of course, is generally regarded as a mature or ultra mature area. Certainly the UK is an ultra mature area. And looked very exposed 5 years ago with all sorts of challenges of high costs, facing decommissioning for both fields and infrastructure. And I think it's one of the triumphs of the industry at large that the North Sea came through so well 5 or 6 years ago. And it'll be very much the same challenge and I think the same playbook this time around. So yes, it's still a mature area. Yes, costs are very high, and companies are going to be under the cosh to do the same sorts of things. How can we get costs down? How can we minimize investment to remain cash flow positive? How can we find a way to extend field life? So that we don't hit the buffer in terms of losing our infrastructure, losing our platform. So I think we should be under no illusion it's going to be difficult in the North Sea. I think the thing that's going to be obvious quite soon is investment. So there's a lot of investment planned in the North Sea, both in existing and in future projects. Where will these stand? On the plus side, most European or Northwest European fields have the luxury of access to infrastructure. That's great. But on the other hand, they're typically relatively small. And generally speaking, quite a high cost. So we had been expecting a number of final investment decisions made on new projects over the next year, and I think we'll see fewer and fewer of those come through as companies just wait and see. Where is the oil price going to settle? Does this project make sense? Can we go back to the drawing board and re-engineer it? So I think we'll see investment slow, but I think to wrap up that section, I'm very positive because of the bounce back we saw in 2015, 2016. The industry did so well. I'd be very surprised if we don't see another sterling performance come from Northwest European operators to keep the industry going.
Yeah, let's certainly hope so. In terms of the levers that you mentioned earlier, companies were pulling all sorts of different levers trying to bring down their cash flow break-evens last time around. And one of these levers in the last downturn was M&A. So asset sales were really deployed very strongly across the board to boost cash flows. What kind of chance they have with this lever? Can they pull this lever this time around, given that M&A market has already been very, very slow and with concerns of the energy transition, etc.?
Yeah, there's uncertainty on uncertainty when it comes to buying assets. You've got the commodity price uncertainty in the near term, and as you say, in the longer term, there's big question marks about other aspects like the energy transition. Where we are at the moment is a very illiquid M&A market, and it's been that globally for the best part of 12 months now, principally for the reasons you say. And the situation we have at the moment is not going to help that. I think we're going to have a hiatus with very little trading going on. But the industry, it needs to turn over assets. But to get that to happen, you have to reach the point where a buyer and a seller come to an agreement on the asset price, which in turn needs them both to be fairly close in the long-term oil or gas price that they're factoring into an asset. There are other factors as well, but that's absolutely key. And I think we're a long way away from that. I think if I were a seller, I had an asset on the market, I'd be hoping a few weeks ago for a $60 plus price to be factored into the asset. Whereas, as you know, this price is half that at the moment. So there needs to be a narrowing of that bid-ask spread. It will come, but I think it's going to be a few months. Then I'd say you will start to see deals done because the industry needs to do deals. Some may need to do it for distress reasons because they're trying to shore up the balance sheet. Others because they want to move on and focus on assets where they're advantaged. So you'll start to see things move. I'd be surprised if we don't see things begin to move in the second half of the year. And there's great opportunity in situations like this. If you happen to be capitalized, either as an international oil company or perhaps an NOC and private equity, there's going to be great opportunity to dive in and get an array of different types of assets that suit you. So I think that's the next phase that begins perhaps in the second half of the year. And I think the final point I'd say is that what we've learned over the last decade, particularly after 2014, is that companies no longer hoard assets. In the old days, you'd hold on to an asset even if it was high cost because you thought it would come good eventually because the oil price would be $100 a barrel or even more. Nobody expects that anymore. So it's a matter of pruning your portfolio, selling assets that are non-core, may not reach the return on capital employed that you want to ever, and is worth more to somebody else. So I think there'll be be another phase where we see a lot of asset churn. That's maybe a year or two away, but it definitely will come back. I think we're in a long-term phase where companies are zooming in to the assets that really work for them.
Thank you, Simon. And that's kind of really interesting from the perspective that just a couple of weeks ago, before the coronavirus and the price war happened, there were a lot of concerns around carbon content and how energy transition is going to affect M&A activity, and that has been in many ways one of the key stumbling blocks in that has stopped sort of strong M&A activity going a few weeks ago even. But in this kind of price environment, there's a whole host of new questions and opportunities that are being opened in terms of the energy transition and where the sector could be looking towards. And so until a couple of weeks ago, the energy transition has very much dominated discussion in the oil and gas sector. Every board continuously debated on what to do and how to respond to increasing investor, regulatory, and consumer pressures. And many of the companies have already responded to these pressures by embracing carbon reduction targets. The majors have very much led the sector because not only did they commit to carbon reduction targets, and this is mainly European majors, they have also created strategies, long-term strategies for diversification into clean energies. And that was all very well in a $60 per barrel environment. Many of these companies could afford to do this. They were breaking even well below that. They were all cash flow positive. Now that we are at $25 per barrel, we are facing a very different situation, and many people are asking as to what kind of effect this may have on carbon emissions. How is this going to work for the energy transition? It's absolutely clear that as companies, many of the companies are now fighting for survival and they're cutting budgets across the board, that carbon reduction budgets will also be affected, and in many ways also diversification budgets. But at the same time, the majors group, for example, that has led the sector in this respect, has shown already continued commitment to low carbon strategies, diversification to renewables. We've had BP, Total, Shell, all announcing cuts and across the board, but actually new energies are exempt from these cuts, and there's continued commitment, in many ways emphasized commitment to carbon strategies and diversification to clean energies. So that has been really interesting to see. So even though some companies will obviously suffer in this environment, and this will affect carbon budgets, the main investors in this space are going to continue with their commitments, I believe.
Yeah, I think that's really interesting, Vanya. So you've been asking me a lot of questions. Let's turn it to you then. So you absolutely say, we've seen Shell, Total, Equinor, and BP. What you're saying, move into renewables and the rest of the suite of decarbonizing projects. You're saying you think that they will maintain that commitment. Do you think they might even accelerate investment there?
Yeah, I think they may well accelerate investment into renewables, and there are different reasons for this. In a $35 per barrel environment, we are looking at a situation where oil and gas projects are actually, the weighted average returns from pre-FID projects that are yet to be sanctioned projects are at now 6% at $35 per barrel, which is very much in line with what projects from solar and wind sector are returning. So suddenly at this oil price environment, actually investing in renewables looks like a very, very good opportunity. And let's not forget that once this blows over, this crisis blows over, the sector, including the majors, and especially the majors, will continue to be under the same pressures that were under 2 weeks ago. And if not, these pressures are going to be even more intensive, because there is this understanding that actually combined with the opportunity that is opened through the more competitive returns, there is understanding that actually now investing in low carbon energy is now even more important, given the link between climate change and the current pandemic. There is research has shown that actually pandemics are closely related or correlated with climate change and loss of biodiversity. So in many ways, actually, and that kind of opens the whole question as to kind of how the world is going to react to the energy transition after the pandemic is over.
Yeah, so what you're saying is that the returns in renewables used to look pretty modest, but now they match oil and gas returns, which are inherently riskier. So we should start to see more capital put in the way of renewables and zero carbon opportunities.
Yes, I mean this is exactly what I think is going to happen, but it's not going to happen across the sector. And there's another sort of question that has been raised frequently as in terms of how the oil price collapse or sharp downturn in oil price is going to affect growth in renewables overall. Well, let's do kind of a little analysis on where actually oil and gas is, and investment from oil and gas companies is in the renewable sector. It's a very tiny proportion of the overall global investment in renewables. And actually, when you look at the historical trends, you can clearly see that, especially during the last downturn, that actually oil price is very much uncorrelated with the investment in renewables and growth in renewables. And fair enough, this has been very much supported by different government subsidies over the past decade as investment in renewables grew. But there is overall on the global scale, mainly the majors, the oil and gas sector overall accounts only for 2% of global solar and wind capacity. So really, even if they stopped investing in renewables altogether, this is not going to have a huge impact on the overall global growth in renewables. What is going to affect renewables is this disruption in the supply chain that stems from the coronavirus, the disruption. So, and yes, we do think that over this year, next year, we are going to see a slowdown in deployment of capacity in renewables, both solar and wind. But going beyond that, we expect this activity to pick up very, very strongly, and we expect to see huge growth in both to continue exponential growth in both of these resource themes on the renewable side. So renewables will continue to grow. This is a mega trend that has been growing and happening outside of the oil and gas sector. So now we are in the situation where we have $35 per barrel, and suddenly at $35 per barrel, opportunities in what has been a very traditionally very low return sector, renewables, opportunities there suddenly look more attractive. And this is one of the key reasons as to why oil and gas companies are more likely to look at these investments as really strong opportunities to hedge their cash flows, opportunities to actually return stable, low risk, returns to their shareholders.
So that last word you mentioned, Vanya, shareholders, the sector's struggled to attract investors into the sector for quite some time now. Do you think investing in new energy is a way to bring investment from fund managers back into the sector?
100%, Simon. ESG has been playing an increasing role in strategies of many oil and gas companies over the last few years, and the pressure from ESG funds and financials is just going to increase. So 100% that is the case.
Good answer, Vanya. And my final point is just to say, yeah, new energy is the coming thing. I think we will see increasing investment in that space, but we're going to need oil and gas for quite a long time yet. We would Mackenzie expect demand to recover to past levels that we saw at the end of last year, and continue to grow albeit at a declining rate well into next decade as well. We think peak oil comes about 2034, 2035. So the oil and gas business will be in business for quite some time, but we'll be investing in parallel in zero carbon assets as well. Ingvild.
Thank you, Simon and Valentina. I think this has been a great discussion to follow. I'm really eager to listen to you because it's kind of, you reflect that we are in a difficult position. We're in the perfect storm. Somebody called it the black swan, and the oil market is having a double storm. But still, you were very optimistic on the renewable side, on the energy transition side, and that makes me optimistic. So I just wanted to close by thanking the two of you for joining us. It's been a pleasure, and we'll hope to see you again soon. Bye-bye.
Thank you.
Thank you.